Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Junk Bonds Investing, a high-yield guide for 2024. Investing in junk bonds can be an exciting journey with the potential for high returns. By understanding how to buy junk bonds directly, leveraging mutual funds and ETFs, and employing smart diversification strategies, you can mitigate risks and create a robust investment portfolio. Keep learning and stay updated to make informed decisions in this dynamic market. Analyzing junk bonds. Knowing how to analyze junk bonds can make all the difference in making a wise investment. Understanding the financial health of the companies issuing these bonds and keeping an eye on the broader market conditions are two vital components. Here's how to approach each one. Financial health of issuers. Assessing the financial stability of the company issuing a junk bond is crucial. A company's financial health gives you clues about its ability to repay its debts. Here's what you need to look at. Balance sheets. Check the company's assets, liabilities, and equity. A strong balance sheet shows the company has enough assets to cover its debts. Income statements. Look at revenues, expenses, and profits. Consistent profit demonstrates a company's ability to meet its debt obligations. Cash flow statements. This reveals how much cash the company generates and spends. Positive cash flow indicates that the company can pay interest and principal on its debts. Understanding these financial documents helps you gauge whether the company can handle its debt load. Additionally, consider the company's debt-to-equity ratio. A higher ratio means more debt compared to equity, which could spell trouble if the economy takes a downturn. Companies with lower debt-to-equity ratios are generally in better shape and are safer bets. Market conditions. Broader market conditions play a pivotal role in the junk bond market. Economic conditions, interest rates, and overall market trends can significantly impact the performance of junk bonds. Here's what to consider. Economic indicators. Factors like GDP growth, unemployment rates, and consumer spending can affect a company's ability to pay back its debt. A strong economy can boost company profits, making it easier for them to meet their obligations. Interest rates. Junk bonds are highly sensitive to interest rate changes. When interest rates rise, the price of existing bonds usually falls. Keep an eye on the Federal Reserve's interest rate policies and projections. Market sentiment. Investor confidence can drive junk bond prices. If investors are optimistic about the economy, they might be more willing to take on risk, driving up junk bond prices. Conversely, during economic uncertainty, junk bond prices can drop as investors flee to safer assets. Staying informed about market conditions and economic trends helps you make better investment decisions. For instance, in a booming economy, junk bonds might thrive as companies grow and default risks decrease. In contrast, during economic downturns, the risks associated with junk bonds might outweigh their potential rewards. Analyzing junk bonds. Summary. Analyzing junk bonds involves looking at both the financial health of the issuing companies and the broader market conditions. By carefully examining financial statements, understanding key economic indicators, and keeping a pulse on market trends, you can make more informed decisions and better manage the risks associated with high-yield bond investing. This dual approach ensures that you're not just chasing high returns but also considering the stability and potential growth of your investments. Stay diligent, stay informed, and you can navigate the thrilling yet risky world of junk bonds with confidence. Strategies for investing in junk bonds. When it comes to investing in junk bonds, having a strategy can make all the difference between success and failure. Here are some effective strategies that can help you maximize returns while managing risks. Long-term versus short-term investing. Choosing between a long-term or short-term investment approach depends on your financial goals, risk tolerance, and market conditions. Here's a breakdown. Long-term investing. Holding on to junk bonds for several years can provide higher returns, especially if the issuing company improves its financial health. Long-term investors often benefit from compounding interest and potential capital appreciation. This strategy works well in a stable or growing economy. Short-term investing. For those with a lower risk tolerance or who are wary of market volatility, short-term investing might be more suitable. This involves buying bonds with shorter maturities or actively trading bonds to capitalize on market fluctuations. This strategy requires a more hands-on approach and keen market insight. Consider your financial goals, risk appetite, and market conditions when deciding between these two approaches. Both strategies have their merits, and the right choice depends on your individual circumstances. Active versus passive management. Another crucial decision is whether to actively manage your junk bond investments or take a more passive approach. Active management. This involves regularly buying and selling bonds based on market analysis, economic forecasts, and company performance. Active managers aim to outperform the market by making strategic decisions. While this approach can yield higher returns, it requires time, expertise, and often higher transaction costs. Passive management. This strategy involves holding a diversified portfolio of junk bonds, such as through ETFs or mutual funds, without frequent trading. Passive management focuses on long-term growth and minimizes transaction costs. It's a less hands-on approach and is ideal for investors who prefer a more straightforward strategy. The choice between active and passive management depends on your investment style, knowledge, and the time you can dedicate to managing your investments. Active management can offer higher rewards but comes with increased effort and risk. Balancing risk and reward. Balancing risk and reward is essential in junk bond investing. Here are some tips to achieve this balance. Diversify. Spread your investments across different sectors, companies, and geographies. This reduces the impact of any single bond defaulting. Credit analysis. Conduct thorough research on the issuing companies. Understanding their financial health helps you assess the risk accurately. Monitor market conditions. Keep an eye on economic indicators and market trends. Adjust your portfolio based on changing conditions. Use stop-loss orders. These orders automatically sell a bond if its price drops to a certain level, limiting your losses. Consider professional help. If you're unsure about your ability to manage junk bonds, consider hiring a financial advisor or investing in professionally managed funds. Balancing risk and reward involves understanding your risk tolerance, staying informed, and making strategic decisions. It's about finding the right mix of investments that align with your financial goals and risk appetite. Strategies for investing in junk bonds. Summary. Effective strategies for investing in junk bonds involve deciding between long-term versus short-term investing, active versus passive management, and balancing risk and reward. Each approach has its benefits and drawbacks, and the best strategy depends on your individual financial goals, risk tolerance, and market conditions. By diversifying your investments, conducting thorough research, and staying informed about market trends, you can navigate the junk bond market with confidence and maximize your returns while managing risks. Investing in junk bonds can be a rewarding endeavor if approached with the right knowledge and strategies. By understanding the basics, analyzing financial health, assessing market conditions, and implementing effective investment strategies, you can make informed decisions and potentially reap significant rewards. Remember, junk bonds are high-risk, high-reward investments. Balancing these elements is key to success in the junk bond market. Happy investing! Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.